After the market ructions of last week, it's a pleasure to be able to say this morning that we've seen rallies across the world in trading overnight. European markets started on the positive start that we had in the Asia Pacific region. They added to the gains. And in US trading, we saw a similar positive impulse lift markets across the board. The Dow, the S&P 500, the Nasdaq Composite and the Nasdaq 100 all up by between 2/3 and 1%. And strong gains across the board, with most sectors finishing in the green overnight. But the rally back, naturally enough, was led by those high growth stocks that have captured investor imagination for the last 2 years. AMD and Oracle both up around 4%, Broadcom up more than 3%, and semiconductors in particular seem to do very well overnight. US markets, of course, are closed for the Thanksgiving holiday, so there'll be no action to guide us. But it's pretty clear that one of the key drivers of the rally in the US was expectations of a rate cut and pricing of the potential for a rate cut at the December meeting next week from the Federal Reserve has increased from 30% a week ago to now 90%. And the reason for that is twofold. One, we've seen a number of Fed speakers since last Friday talking up the possibility of a rate cut in December. And we also saw the release of the Fed's beige book. Now, this is very important at the moment because we don't have a lot of data from the US government. After the shutdown, we're still waiting on numbers for inflation and for employment, which would guide the Fed. But we know the Fed itself takes its own sampling of the economy from its 12 offices around the US. And when they collate that information, the anecdotal information from the ground, they publish it monthly in what's known as the beige book. Now, this means that the Fed does have some finger on its pulse of the US economy, despite the lack of data from the Bureau of Statistics. And the Fed speak that's been rolled out over the last week has clearly indicated that they believe there's room for them to cut in December. And that's what really fueled the market rally. Now, you might recall in our 2025 outlook last December, a good 12 months ago, we talked about the possibility of central banks diverging over the course of this year, that they would respond much more to what's going on in their own economy. And that's exactly what we're seeing, because while the market is speculating about Fed rate cuts, in Australia, the talk is now about potential rate hikes. And the reason for that is very clear. The inflation data we saw this week was a shocker in terms of the potential for lower interest rates. The headline rate at 3.8% captured the imagination, but the real problem here is the median rate at 3.3%, well above the target range and going in the wrong direction. And that means that the RBA is much more likely to lift rates than cut them. Now, I don't believe that's been priced into the equity market as yet. The main driver of that inflation is around cost of living, and in particular, the removal of subsidies for electricity. We're now seeing a potential for 2 rate hikes next year. Bond traders have flipped around. And the potential here is a big markdown in the Australian share market. If interest rates are heading higher, not lower, that changes everything. It changes the outlook for the economy because of the impact of a tighter monetary policy, and it changes the outlook for companies because of higher borrowing costs, and it changes valuations. Those higher interest rates feed into every valuation model and knock valuations lower. So in my view, the market has not yet priced fully the potential for higher Australian rates, and we could see a period of divergence in the Australian share market where it underperforms as investors price in the possibility of those rate hikes, even while other central banks around the globe are cutting. So turning to our watch list today, top of the list, Temple & Webster. Now, this is a high-end retailer here in Australia. It was smashed in trading yesterday, down 32%. It's now down 50% from an August high. And the reason for that was its report. Now, the revenue came in at up 18%, which sounds pretty good until you realise the previous guidance was for growth of around 23%. The guidance for the future too was very conservative, and the concern here is that weakening economy and the potential for higher rates has driven high-end retail back into its shell, and Temple & Webster under real share price pressure after yesterday's report. It's back to its 2025 lows, and while some might consider this potential bargain hunting opportunity. The momentum is clearly negative in Temple and Webster at the moment. Dell also reported results last night before market, and it ripped higher, up 5.8% after that results announcement. It's up 18% year to date. And the old school computer manufacturer has moved into the AI world. It's shipping 25 billion in AI servers this year, and it cannot keep up with the demand for them. Now, that is a bit of a part of Dell's business model. The way they market themselves, they're always working to a backlog, but nonetheless, that backlog appears to be blowing out. Their third quarter revenue was up 11%. EPS was up 17%. It's the best profit report they've given since their IPO back in 2017, I believe. And clearly it was the guidance too for the next quarter and that big pipeline that really impressed investors. Dell showing some very positive momentum. Another reporter yesterday was Deere Farm Machinery. Now, the John Deere tractor is iconic in the US. It's definitely has a long association with rural America. And so for that reason, to see its profit fall 14% in what is its fourth quarter was particularly concerning. Now, the Deere Farm Machinery Company was not shy in pointing out that the big problem for them is tariff costs. And they've doubled from a bit over 500 million last year, this year, to 1.2 billion for the full year of 2026. And that doubling in tariff costs has had a huge impact on their bottom line, and investors responded accordingly. The shares were down 5.7%. Now, on the Moomoo platform, we still have a buy rating on John Deere stock, but that impact of tariffs not only has implications for John Deere, but for the US economy.